In 2005, a stripper in Florida owned 5 houses. She didn't have a down payment. She didn't verify her income. The banks didn't ask questions. They just kept saying yes. 2 years later, all 5 mortgages were worthless, and the global financial system was on fire. This is the story of the biggest housing scam in American history. And the terrifying part, almost no one saw it coming. We're going to break down exactly how millions of ordinary people, giant banks, and the entire economy got pulled into a scheme so absurd it sounds like fiction. But first, you need to understand what a mortgage actually is, because that's where the con begins. A mortgage is simple. You want to buy a house. You don't have $300,000, so a bank lends you the money. You pay them back over 30 years with interest. The bank makes a profit. You get a home. Everyone wins. For decades, this system was boring. Banks were careful. If you wanted a mortgage, you needed proof of income, a solid credit score, and at least 20% down. The bank wanted to be sure you could actually pay them back, because if you defaulted, they were stuck with your house and a loss. This made bankers conservative, even a little paranoid, and that kept the housing market stable. But in the late 90s, something changed. Wall Street figured out how to turn mortgages into a product, not just a loan between you and your local bank, a tradable asset that could be sliced up, repackaged, and sold to investors around the world. They called them mortgage-backed securities. Here's how it worked. A bank gives you a mortgage, but instead of holding on to that loan for 30 years, they sell it to an investment bank, Goldman Sachs, Lehman Brothers, Bear Stearns. These guys bundle your mortgage with thousands of others and create a new financial product. Then they sell shares of that product to pension funds, hedge funds, foreign governments. Everyone wants in because housing prices only go up, right? This changed everything. Suddenly, your local bank wasn't worried about whether you could pay back the loan because they weren't keeping the loan. They were selling it off within weeks. Their only job was to create as many mortgages as possible and pass them up the chain. The risk disappeared, or so they thought. By 2003, the mortgage machine was running at full speed. Investment banks were screaming for more loans. They needed the securitization pipeline. So the banks that actually gave out mortgages started lowering their standards. No down payment? No problem. Can't prove your income? We'll take your word for it. Bad credit? We have a product for that too. They called them subprime mortgages. These were loans given to people who had no business borrowing hundreds of thousands of dollars, but the banks didn't care because in this new system, risk was someone else's problem. And there was another trick, adjustable rate mortgages. Here's how they sold it. Your monthly payment starts low, maybe $800. You can afford that. But buried in the fine print, after 2 years, the rate adjusts. Suddenly, your payment is $1,400, then $2,000. Most borrowers had no idea. The broker just told them housing prices were going up so fast they could refinance or sell before the rate kicked in. It was a time bomb with a smile. Mortgage brokers were making a killing. They got paid per loan, not per successful loan. So they had every incentive to approve anyone with a pulse. There are documented cases of brokers filling out applications for people who didn't speak English. Janitors were approved for $700,000 loans. A man listed his income as $1 and still got a mortgage. This wasn't lending. It was fraud dressed up as innovation.